The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
A glimmer of hope for rate cuts as Powell lays out a scenario of economic balance. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Alex Steele. I have a surprise for you.
What's the surprise, Alex
Another
Steele?
record on the S&P.
Another record on the S&P, Alex Steele.
36 record highs. S&P up 0.1%. But again, we're just sort of grinding higher with nothing to write home about. What is doing well within the stock market, Romaine will get to this in just a moment, are the banks. Powell talking about potentially we're going to see lower capital requirements for some of the big guys. 210 spread. It's what everyone's really looking at when it comes to those steepeners as well as the 530s as well. So a little bit steeper, but it's where we see that steepener that is the real question. And dollar yen, it is a favorite of mine to go to. The dollar is a little mixed on the day, but not when it comes to the yen, Romaine. That dollar continues to be strong, even though Powell was neutral to dovish.
A close eye on FX, a close eye on what's going on in treasuries, a close eye on what's going on in stocks as Jay Powell wraps up the first of 2 days of testimony to Congress just 3 hours ago. It was a wide range of comments that we heard out of him, where he talked about the risk of lowering interest rates too little or too late, with the labor market and the economy coming back into balance.
This is no longer an overheated economy. This is an economy, as I mentioned in my opening remarks, that is more or less back by most measures to where it was before the pandemic. And that was a strong labor market, but it was not an overheated labor market.
And we should point out that the market reaction somewhat muted, with oscillation in treasury yields and a broader equity market clinging to what could potentially be another record high. Financials out in front on the day, but a huge drag from tech and the software stocks. Salesforce down about 2%, Oracle down 3%, and Unity Software hitting a record low on the day. And that's raising a lot of questions out there about the tech and AI trade, with strategists at Citi and at Morgan Stanley among those saying it may be time to take profits from that relentless run-up in valuations that ostensibly kicked off last November as traders correctly bet that the Fed, Alex, was done raising rates.
Yeah, and that's when the two-sided risk, right? This is really what this chart shows. Let's take a look at this. The top is jobs, bottom, inflation. So the pink line here is the 3-month moving average when it comes to employment. And you can just see here, we're just sort of slowing down. The trajectory is just a little bit slower. On the flip side, you have inflation at the same time, the lowest level we've seen on an annual basis since March of 2021. Inflation coming down, jobs coming down. And the question we have, Romaine, really is, when does the Fed pivot more to growth than inflation? And from what Jay Powell was saying, I wonder if we're very much nearing that pivot point.
Stuart Paul joining us right now over at Bloomberg Economics. He'll kick us off to the close. And Stuart, when you listen to the testimony that we got out of Jay Powell today, you did get this theme of balance there. Is there that shift to a little bit more focus on growth rather than just the inflation side of the equation?
He did emphasize that the balance of risk has basically been restored. That's really to say that the risk of a surge in inflation is about the same as the risk of a more rapid rise in the unemployment rate. The second thing that he really emphasized is that the labor market has been cooling dramatically. And the third thing, an unexpected increase in the unemployment rate would warrant that policy pivot. But with the Fed and the FOMC members expecting the unemployment rate to basically hold steady through year end and then actually come down a little bit, any modest deterioration of the labor market would warrant a pivot. We're expecting the unemployment rate to hit about 4.5% by year end, which keeps 2 rate cuts in play.
When would that rate cut start then? If you're looking at 4, I mean, that feels like a big jump. 4.1 to 4.5, I feel like would freak some people out.
It would. I think that if we hit 4.2% by September, that puts a September cut in play. And I think that that's definitely well within our reach. 4.1 in the June jobs report, it puts us right on the cusp of that 4.2% threshold, which would get people getting a little bit nervous. They'd start checking their SOM roll calculators. And
You're already doing that, man.
And I think that the folks at the Fed would be doing the same. And they'd start becoming a little bit more antsy and would potentially consider cutting in September.
What's the data point, though, that gets us to that? I mean, when Powell was asked about this question, as always, he was evasive, but he seemed to kind of suggest that they need to see, I guess, more good inflation data. I forgot the exact terminology he used, but the idea here is that they don't necessarily have everything they need right now to make that choice.
I think that his primary inflation indicator is going to remain super core services. So that's core services excluding housing on the inflation side. I think that on the labor market side, he's really looking at the vacancy to unemployment ratio, which is now basically back to where it was pre-COVID. And so any little uptick in the unemployment rate could be enough to tip the scales.
All right, Stuart, thanks a lot. Really appreciate it. Stuart Paul of Bloomberg Economics. More good data, I think, Romaine, is what he said, for inflation. More good data.
Yeah, which I was like, which I had to wrap my head around because I was like, does that mean you want higher inflation?
I know.
Lower, but like good is bad, bad is good.
It's a whole,
it's a topsy-turvy world, Alex.
It's too hard when he's talking like that. All right, Gargi Chaudhuri is BlackRock Chief Investment and Portfolio Strategist for the Americas, joins us now. Her team also just released their latest mid-year investment outlook, which we will get to. But Gargi, we wanted to talk about the Fed first. September cut more likely, or November, December?
Hi, Romain, Alex. It's wonderful to be here. Thank you for having me. So we think that September is likely when the Fed's going to begin the cutting cycle. Still in the camp of expecting 2 rate cuts this year, so September and December most likely. Definitely, I was listening to your colleague from Bloomberg earlier that was talking about the data and what the Fed's looking at. Obviously, if the unemployment picture worsens significantly, much more than what the Fed or the market has expected up until now, I think you can expect the market to price in more than 2 cuts. But I think what the market's pricing in now, around 2, seems absolutely fair to us. And I think they start in September.
Does that happen? So what happens to the curve in that point in terms of the steepener? Do we get a steepener finally that's sustainable? And is it the front end that really comes down, or is it the back end that gets hit harder?
Yeah, so we've been talking about this for a while, that, there's such attractive income in the fixed income markets right now. You can get this diversified income at 6% or over that with a whole host of fixed income securities. But where you source that duration is important. And we've been on the camp that you want to source that in the belly of the curve for now, expecting the curve to steepen out. We've seen a little bit of that steepening, of course, but I would imagine as there is more concerns around the fiscal deficit, or if there's more concerns around, just the amount of supply that's coming into the market, I think we can certainly see bouts of steepening. And eventually, for us to get a lot more positive on the very long end of the yield curve, we'd have to see a positive term premium return to the market. For now, if you can clip 6% or so quality high coupon in the fixed income market with, we like owning investments such as BlackRock Income ETF, why not do that and clip that coupon?
I am curious, though, on the term premium side, Gargi. I mean, how much of that is sort of still correlated with what the Fed is doing or may do, I should say? Or are there other factors here that have driven that premium to where it is? Or lack of it?
Yeah, so, historically, absolutely. It's a great point. Historically, when we think about what drives different parts of the yield curve, obviously you have your growth and policy and all of that driving sort of the very front end. Then you have other factors that drive the very long end. So if you're looking at anything that's 10 plus, obviously it's growth and inflation too, but you do have concerns around supply, concerns around deficit, which is why investors will demand a higher return. And you're not getting that right now. Right now, why would you stick around for another extra 25 years while getting less yield for those extra 25 years? So I think a lot of this is on valuations, and the drivers of the long end are related to demand, supply, and deficits like we talked about, which are all pointing to a little bit of a steepener further from here.
All right. Well, Gargi, I think we'd all like to be around for another 25 years, but sit tight. We're going to keep you around for at least a few more minutes. Gargi Chaudhuri, she's the Chief Investment and Portfolio Strategist for the Americas at BlackRock. She's sticking with us. When we come back after the break, we're going to get her thoughts on highlights from the latest mid-year investment outlook over at BlackRock, and a big focus there on AI and tech. This is The Close on Bloomberg.
As promised, BlackRock out with its mid-year outlook today. Artificial intelligence, a top theme, strategist writing, while AI will streamline operations, improve customer experiences, and drive human innovation, identifying the most promising AI-driven opportunities requires expertise and vigilance. Gargi Chaudhuri is Chief Investment and Portfolio Strategist for the Americas at BlackRock, back with us. All right, you teased it up. How do you do with it?
Yeah, absolutely. So look, one of the themes that we're talking about in our mid-year investment directions is the idea of having quality at the core of your portfolio. So quality which can be defined by companies that have strong profitability, that have low leverage, that have stable earnings. And we've certainly seen that come to fruition through the course of this year and last. And that, we believe, will continue to be with us for the next few months. Now, in addition to that quality being a part of your core, there are other trends in the marketplace, such as AI that you just referred to, that are going to be with us and drive not just returns, but actually growth and probably even inflation for many, many years to come. And here, this is where I think there's a few interesting things. Obviously, the traditional AI plays, such as semiconductors and going to areas of the market such as stocks, have played out and can continue to play out. But the broadening of AI, which I'm very excited about, is really about looking at what else is going to get impacted by the AI trade. And this is where we think areas such as utilities, areas such as energy equities that have been not as loved, I won't say unloved, but certainly not as loved as the tech play, have much more room to go. So we're talking about the AI trade as well as the broadening out of the AI trade, and then keeping quality both with active management and with funds such as Qual at the core of your portfolio.
But where do you see that AI trade, though, going, Gargi? I mean, we've already talked a lot about the power needs and how that benefits the power companies and utilities, and we've seen some people gravitate to those stocks. But when you talk about that true broadening of the trade, you have to start to get to the end use cases, which I know for a lot of these companies we're still a long way away from. But as an investor, how do you map that out?
Yeah, I think that, look, when we look at the flows in utilities, for example, to your point, obviously that, a lot of people are focusing on that now. But if you look at the flows, and we spend a lot of time looking at that hasn't actually played out. Sectors like utilities are still more or less in outflows. So I think this is just the beginning. We're in the early innings of the AI, as well as the AI broadening out trade. And I don't think it happens in the same straight line that we saw, semiconductors or just the technology sector move. I think we're going to have fits and starts, especially as rates and fear around elections, et cetera, drive some of these sectors. But I do think that this is a longer-term opportunity given the power needs of AI.
When we talk about the tech trade overall, so let's just broaden that out from beyond just AI and those that benefit. There's been a lot of talk here that some of that juice, or some of the buying that we've seen in the AI space has been at the expense of other tech stocks that don't necessarily have an AI theme. Has that created any opportunities there? Are you seeing people at least maybe kick the tires in that space?
I think some of this was just around earnings expectation, right? Even if you look at earnings season expectation for just this earnings season, which is kicking off on Friday, the expectations for earnings growth are strongest in technology and communication services at around 17%, right? Now, what we are going to expect to see, especially as we get towards 4Q, is that gap narrowing a little bit. So I think that this is the time to still keep quality at the core. That can mean sectors like healthcare, and then broadening out the AI trade, like we said, to energy and things like utilities, and then be very quick and nimble about rotating when the other sectors that are away from the broad tech plus sectors, if you will, start showing some of that earnings growth, which frankly is yet to be seen. We just haven't seen it. The performance has been related to the earnings growth, which has been missing.
Right, and I wonder if we continue that theme, do we see that this earnings season, or we have to wait for the next quarter where we finally see the big tech players' earnings start to come down a little bit and that earnings momentum to gather elsewhere?
I mean, as of right now, if I look at expectations for this earnings season, if you look at the S&P outside of the top 6 or 7 names, it's still a positive number, the expectations for earnings, but it's significantly lower. It's about 5 or 6%, much, much lower than the top names. I think we need to see that turn a little bit, and I expect some of that to begin to get priced as the earnings momentum and the earnings picture changes, which looks, as of right now, to be Q4. But obviously, we will wait to see how these companies do. And frankly, I think there is something to be said about many of these large communication services and tech sectors that are posting these healthy margins, which other sectors are just not able to. Again, like I said, I think broadening out to sectors such as energy, which has shown some good margins come through, is something that we think investors should do as one of those offshoots. It's not your core of your portfolio. It's something that you add to your core. I think that works as we go into the remainder of this year, but quality at the core remains the key, especially if we get a little bit of softening of data as we go into the second half of 2024.
All right, Gargi, got to leave it there. Always a great conversation, always smart. Gargi Chaudhuri there is Chief Investment and Portfolio Strategist for the Americas at BlackRock, helping us kick you off to the close. Alex Steele, here on this Tuesday afternoon, I thought it was interesting, too, like when you talk about the long-term AI play and whether it evolves beyond just chip stocks and, a couple of utilities and software names. Like, where does that go? Like, what is the end case? Because I don't know anyone who actually uses this, at least, or pays for it. Regular people. I'm sure some companies are paying for it.
I'm not a regular person who does that, so there is that. But I think what you're bringing up is the whole how you monetize it and how it grows, and then you get to the cyclicality of it, too, at the same time.
Yeah. Wait, you're saying this is cyclical?
No, we don't know yet.
Oh, okay.
Of course it's going to be.
So we hype this all the way on the way up, and you're saying in a few months or a couple years, we're going to talk about the big hype on the way down.
Yeah, it's going to be, but we don't know what that is.
Yeah.
Is that like a decade?
I love that. You know why, Alex?
Why?
Because it keeds us employed. All right,
Fingers
a lot more
crossed,
coming
guys.
up here
Fingers
on the big program here, or maybe. Who knows? They might get tired of us soon. Who they're not getting tired of is Bobby Jane, actually pulling off one of the biggest hedge fund launches of all time, raising more than $5 billion in a very tight market.
All right, plus our stock of the hour is the consumer products company Helen of Troy. Shares falling the most intraday on record. We're going to look at what caused that big dive.
Do you know what Helen of Troy makes?
No, you told me.
OXO Good Grips and the Braun.
Is that the hair thing?
No, OXO Good Grip for the kitchen,
Oh,
kitchen
yes,
thing.
right, that guy.
Okay, all right, don't make me make another kitchen joke about you here. All right, and we're going to take a look at shares of the home builder Lennar, up about 1% today on the back of an upgrade by Wedbush. We're going to talk to the analyst behind that call. Don't go anywhere. This is the close on Bloomberg. All right, let's get a view from the sell side. Our top calls, the big movers on the back of analyst recommendations. And we start off today with McDonald's. Gordon Haskett not loving it at all, cutting its price target to $2.80 from $300, with the firm saying that the initial customer response to that $5 meal deal, it's been underwhelming and has barely moved the needle on foot traffic. But the firm does expect this to prompt an aggressive sales push, so they're going to stick at least with that buy rating for now. The share is down 1% on the day. Next up, Chewy, a downgrade to hold. This over at Argus Research, with the analyst citing declines in Chewy's active customer list. They're saying more households are tightening their purse strings. She also has some concerns here about substantial investment spending as Chewy expands into Canada. Those shares down about 3% here on the day. And let's take a look at Bank of America. Before today, they only had one sell rating. Today, they have none. Piper Sandler upgrading to neutral, predicting large banks will see net interest income bottom in the most recent quarter and then head higher for a sustained period. They no longer see a good reason to single out Bank of America for underperformance, bumping the price target to 42 from 37. The shares bumped up by about 2% on the day. And those are some of our top calls. We do want to stick in the sell side space and take a look at one more call, and that came out of Wedbush on Lennar. Wedbush sold on Lennar's land spinoff, upgrading the stock to neutral from underperform with the unchanged price target of $144. Now, while the analyst has a cautious view on entry-level and spec-heavy builders like Lennar, that hasn't changed. He still believes, though, that the deal may be the next catalyst for the shares. Joining us now is the analyst behind that call, Jay McCanless, Wedbush Senior Vice President and Equity Research Analyst. All right, let's start off with this here. How does land spin help, Jay? I think we're having some issues with Jay's audio there. So, Alex, I mean, this gets to a bigger issue here when we talk about kind of these, lower-end entry-level home builders, I guess you can call them, and sort of what gives them sort of a better line on profitability. And maybe these types of acquisitions can help with that here or not. But I don't know, I feel like the housing sector, the new home sector, is right at this point just kind of riding on, I guess, kind of just the momentum that we've seen for quite some time, which is just low supply.
Yeah, and also the low supply, but because affordability is so tough, what kind of concessions these guys have to make to get people to buy their homes, and that really creating some difficulties.
All right, great conversation. Let's go back to Jay McCanless.
We were great there. We were really good.
Who is still with us right now. Jay, thanks for being patient with us as we sorted out those audio issues here. Talk to us a little bit about this land spin deal. Explain it to us for our viewers.
Sure, and thanks again for having me on. They haven't announced the timing of the deal yet, but what theoretically this deal is going to do is create a new land banking opportunity for Lennar. It should help improve, in their opinion, ROEs and returns, and make them a more efficient. And we all heard the just-in-time theory in school, and that's where some of these larger home builders are wanting to go now. Is when they have the buyer in hand, or when they feel like they need to start a spec, they'll be able to essentially take a lot that's ready to build on and that's what land spend, and that's our term, by the way. Lennar hasn't really named it yet, but we think land spend, that's what it's going to become for them, is a just-in-time provider of finished lots, so that Lennar can concentrate on what they do very, very well, which is build homes.
And that's a good point here, Jay. And by the way, you should trademark that before Lennar does. But I am curious that now with this sort of out of the way and the idea that they can focus more on this, I mean, what is kind of the health of the market, of the new home market, particularly at that entry level point that Lennar is known for?
So we think right now that the entry level, and you mentioned it in the open, but we believe the entry level consumer is really stretched on affordability. When the builders can solve for the payment, whether it's through incentives or mortgage rate buy downs, they are getting people into the homes. But at the same time, we also think that the builders may have started a few too many homes at the beginning of the year. Understandable, because at the beginning of the year, a lot of people thought mortgage rates were coming down, et cetera. And I think now they've just got to let the demand catch up to supply. And we got negative on the stocks about 3 months ago because of those factors. Mortgage rates also went against the entry-level buyer in April and May. That seems to kind of settle down now, but we still just think there's probably too much supply out there and not enough buyers that can qualify yet to start bringing down that supply quickly.
Hey, Jay, then where's the trough in gross margins for these builders?
Would say it's at least another quarter, maybe two away. We in the promotions that we've seen from the builders, including Lennar and the other public ones that we cover, we have seen, I think, a little higher pace and tempo of incentives and some things that we haven't seen before. They're offering blinds in the houses, extra appliances, things that you normally don't see the entry-level builders providing in those homes. So that's a quirk versus what we've seen the last couple of years. And I think it may be negative for gross margin, at least consensus gross margin estimates.
Hey, Jay, we appreciate it. Thanks so much for sticking with us.
Thank you.
Jay McCanless, Wedbush Senior Vice President, Equity Research Analyst. Blinds with a house. I totally didn't know that. I thought mortgage rate buy downs, but blinds, you know how expensive those things are?
Blind? Yes, I know.
They're crazy expensive.
I know. The first house I ever bought, it had all these beautiful windows. I remember when I bought, this is great, until I realized I had to put, window coverings over all of them, which I think costs about as much as the house.
Oh yeah. No, 100%.
It's a racket, by the way, right? It's just fabric or plastic or vinyl or whatever.
Yeah, but then they can be so pretty when they're like shimmery and or they're windproof. I don't know. But point being, they're expensive, and that's definitely a perk. You get those free blinds. All right, coming up.
I should point out the neighbor across the street from me, he's just got sheets in his window, or her window.
It's choice. It's definitely a choice. Coming up, we're going to talk about the rapid growth of private equity. Is that a bubble waiting to burst? This is Bloomberg.
Just about 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Alex Steele. Staying with tech for a second, and also hedge funds. Let's put the two together for a second.
Put the two together.
Because apparently some tech-focused heavy.
Yes.
Yeah. Ooh, that's good. Some tech-focused equity hedge funds like Whale Rock and Light Street, shocker, have done really well because you know what?
Yeah.
They have NVIDIA.
Well, that's what I say. I want to see what's in that portfolio. Like what got them there? Is it just NVIDIA and a couple of the other big AI plays?
Yeah, pretty much.
Yeah.
But it is performing and it is delivering. But how much you want to pay for that, I guess?
And most investors don't care, right? As long as they're getting their returns, right?
Yeah, but the fees are still pretty steep. But let's stay in hedge funds for a second.
Well, they wouldn't be a hedge fund if the fees weren't steep, would they?
No, they would not. But let's stay in the world of hedge funds. Bloomberg's Hema Parmar has been taking an in-depth look at how Bobby Jane pulled off one of the biggest hedge fund launches of all time. It uses half a dozen trading strategies and employs hundreds of people around the world. Hema joins us now, who also incidentally wrote the story about tech hedge funds and how they're doing. Okay, so this Bobby Jane story is fascinating. It's a really long-form piece and sort of digs into how it got to where it is and the expectations. Just tell us what you learned by creating the piece.
Yeah, so, it's a really fascinating thing that he's doing here. He's doing something that's never been done before, launching a giant hedge fund that is already built out as a multi-strategy firm, meaning it trades 6 different strategies, like SRTs to physical commodities to stocks and bonds and arbitrage bets and quant investing, and building out a firm that's this complex, that has this talent, the capital raising, the infrastructure, it's a big undertaking. And typically when we look at the hedge funds, they have historically started with one strategy and then added more over time. And what we're seeing, he's doing it all at once.
It was an interesting strategy, and it's funny, we laud him for this $5 billion, but he had intended to raise a lot more than that.
Yes.
Why initially was there reticence to this? Was it just because of market conditions, or was it more concern about, I guess, the structure and complexion of this new firm?
It's a few things. It is a very difficult fundraising environment, so every dollar is harder to get. There's a bit more concern over the multi-strategy space. There's less dollars that the investors have because some of it's tied up in private equity. So they're a lot more thoughtful about every single dollar that they put to work. And private credit is so hot, so there's competition there. So, and then you have the day one risk of investing in a brand new fund doing something that's very new. So you can see some people sitting on the sidelines waiting to see how it does after the first year, and then maybe jumping in later.
It's a brand new fund, but with a lot of old folks, meaning experienced
a lot
folks,
of tenured, experienced people.
Not old as an age.
Yes.
You know what I mean.
Yes. And Bobby Jane worked at Millennium. He was co-CIO, spent 2 decades at Credit Suisse. A lot of tenure there, for sure.
All right, Hema, thanks a lot. We really appreciate it. It was a great piece. Everyone should check it out. Hema Parmar joining us from Bloomberg. So speaking of, let's go to private equity from hedge funds. In her latest Bloomberg Opinion column, Allison Schrager writes, markets today pose a new existential question. Can there be a bubble in something if it has no price? Joining us now is Allison. She's also a senior fellow at the Manhattan Institute. Good question. Can you? Is there?
I think it's the question of our time, really. So because so much capital is now going to markets where there is no price. But and I think this has actually been one of the things they argued was great about it is, prices can't collapse if there's no price at all.
Well, so what does a collapse look like, though, in this situation? I mean, just hypothetically, because, these guys will always make it, folks in the private equity space, they always make this argument about not having to mark to market and that they have more flexibility in renegotiating things here. So if there is real trouble there or trouble afoot here, what does that look like?
Well, it's more of a slow bleed than a collapse with like a bubble that would say exists in public markets because, the LPs also just can't pull their money out like the way they can in public markets. So you don't just get everyone running for the hills and freaking out and sort of pulling all their money out and then you have this sort of overcorrection in prices.
Well, sorry, but on that point, because that's a really good point, and we've heard from a lot of LPs grumbling about this, how does that, though, affect the potential for new funding rounds and whenever those vintages, and they do get their money out, are they going to put that back into private equity, or are they just going to say we're done with it and they're going to move on to something else?
I think that's where the damage happens. Is they just, especially pension funds who are sort of not sort of getting their money back now and are finding, they're struggling to make sort of pay benefits, is they just don't go to private equity at all. And in some ways, there's nothing wrong with private equity. Maybe it got a little too big, but it does fulfill an important purpose in our economy. And that might be the overcorrection, is just like people get really scared of putting money in their asset class at all. And then we find a lot of companies that have become a lot more dependent on private financing over the years for a variety of reasons, can't get financing.
So does that money, though, get weirded out by private equity but go to private credit instead?
It might, but private credit might get some of the same issues. I think people underestimate a lot of the risks with private credit. I think for years, a lot of us wondered where the low rate environment where bubbles were brewing, and it might have been largely in private markets. And I think what people don't appreciate sometimes with private credit is that, a lot of their loans are floating rate. So if rates don't go back down, then, they might have a lot of companies that struggle to refinance and they might see more defaults.
In the private equity world, though, has secondaries, I know secondaries have been around for a really long time, but I feel like they've grown so much in a short amount of time also. Has that helped stem bleeding?
Not yet, but I think that might be a symptom for the issue is that, there's reports of these zombie funds where people can't get their money out and they're having to sell on secondary markets and take a big discount. So, so far, we all read Matt Levine. It does seem like it's a fairly opaque market that's not functioning that well either. But if it gets big, then honestly, is it really private equity anymore? Because then you do have a market price on these things.
We do. Does Matt Levine get paid by the word? Because his columns are always so long. They're great, but they're always so long. And yours are very just short and sweet here.
I have a stricter word limit than he does.
And inquiring minds want to know. In all seriousness, though, but you mentioned this idea here, too, of floating rates. And I've heard this argument, too, particularly from the private equities firm's perspective, the idea that they will continue to profit off of this. But, of course, that kind of hobbles the company itself. And I do wonder if a crash, or whatever we're going to call this, a slow bleed, if this does become a situation of liquidity drying up, the companies that are saddled with these loans can't do anything else to invest back in their business, and effectively they either tip under or at least sort of just kind of limp along.
Yeah, which, I mean, I don't know what's worse is if you just, like in public markets, like we have with the tech bubble, this crash, and then there's just this recession and, a lot of this sort of, this cleansing element of the economy, or if you'd get this slow bleed, because people will also lose jobs. I said if their employer can't get financing, and I think people underestimate how much more people are turning to private markets and not going public.
But we've heard from the Fed, I mean, for the first time in a long time, I forgot it was a few meetings ago, we actually saw this mentioned actually in the Fed statement. We saw this come up also in the recent the bank asset test, where they mentioned the role or the connection with private markets here. So it's clearly on the radar of regulators that this is an outsized influence right now in our economy, and no one seems to really know exactly how healthy it is.
Yeah, I mean, I think it always concerns regulators when a lot of money is going to a market they can't really measure or control or regulate. So, I mean, and rightly so. I mean, one thing I feel like we learned after the 1930s is it's a lot better for people to invest in things that are transparent and have a clear market price and are well regulated. Yeah.
That doesn't sound like our market today, does it?
It sounds like actually we've now decided that's all a bad thing.
All right. Well, Allison, you always have a great perspective on these topics. Allison Schrager, she's a Bloomberg Opinion columnist for us here, and also a senior fellow at the Manhattan Institute. A great column today here on, I guess, the question of whether private equity is in a bubble headed for a crash.
Although I do have to wonder, the defaults that we've been waiting for and sort of the fallout and the blow up from higher rates, like where is that?
Well, that's a good question, too, because they are happening, but it's not like en masse.
Right.
And some people have posed this argument that we may end up with just as many defaults as maybe what we had during sort of a traditional recession, but they'll be so spread out over, 2 or 3 or 4 years, as opposed to all happening within 8 or 9 months, that the impact to the economy will be felt less. I don't know if that's true, but that's the opinion.
And somewhat idiosyncratic, right? Like with commercial real estate, it's not like all office towers are toast.
Yeah.
Right? Like it's a very idiosyncratic, specific thing. And how do you then make a big proclaim? How do you proclaim something from that if it's just sort of this rolling default over time?
Yeah, I agree, and it makes it harder too, because I think we all like kind of things that are very sort of dramatic and final and definitive, and the slow bleed. It's hard to do a show around it, Alex. Too.
It is.
All right. When we come back, we're going to talk about some of the big movers in the market today. One of the biggest decliners is Helen of Troy. You may not know that name, but you know what they make: Hydro Flask, OXO Good Grips, as well as a lot of other products. Here, it's our stock of the hour, and it's coming up next, right here on The Close on Bloomberg. All right, let's get right to our stock of the hour. Shares of Helen of Troy down about 30%, the most on record after analysts were surprised by the magnitude of the company's cut in its outlook here. Of course, Helen of Troy is the brand, if you will, behind Hydro Flask, pure water filters. What is it? Hot tools, curling irons. Abigail Doolittle sitting by right now for more on what's going on. So they make a lot of household products.
Yes.
OXO Good Grips for the kitchen. We mentioned pure water filters, the Hydro Flask, Bedhead,
Dry bar,
which I tried to use this morning. Didn't quite work on my short hair, but you must know this here. But what's going on here? I mean, a 30% drop in the stock is pretty dramatic.
Yes.
I mean, are we just not buying this stuff anymore?
Well, the quarter, an absolute disaster, clearly, and it took the management by surprise. They either guided really poorly, which suggests that they had poor visibility, and that's what they're saying. So relative to the numbers, they put up 99 cents in adjusted earnings for the quarter. That was a 38% miss. Sales of about $417 million. That was a 7% miss. It's rare for them to miss. This is the first miss in 21 quarters. So they are saying it's the consumer. They're saying that consumers, the financial situation has worsened, that they're pulling back. They're not really spending on discretionary. And as a result, retailers, are you signaling to Alex, because Alex would not be one person pulling back?
Well, no. Well, I was just saying. I mean, it's just like I feel like some of this stuff is more necessity, right? I mean,
some of it is, but curling irons not so much. Some of those fancy hair products, dry bar, you see those around New York City where you can go in and have your hair blown out.
Yeah, I know it well.
You know that one as well.
But then to that point, why did analysts and why did the company then get it so wrong?
Well, it's so interesting. So if you look at the analysts on the street, most of them are either neutral or bullish. But there's one analyst over at Hedgeye, Brian McGough. He had a short, and I was just speaking to him on the phone, and they think it's going to continue to go down. He said the question is not whether it goes just down a little bit more. It's a question of whether it goes to 25 or 0. So what he is saying is that there are, in the opinion of Hedgeye, a brand destroyer, that their only good brand is Osprey. That has to do with backpacks. But he says, give it time and they'll destroy it, because essentially what they do is they stuff the channel, they don't reinvest, and then they, again, destroy from supply demand standpoint the brand. He's also told me.
I just want to point out, too, I was just looking at the short interest. I mean, short interest is kind of like quadrupled.
Well, they've been short on this for a while, or they've had this short call on it for a while. So I think that there are some people at least, that are a piece of this. But there had the old CEO left recently, that person probably stuffed the channel, so that could be a piece of why the numbers were so off. In addition, they have $16 million in cash, $750 million in debt. They bought back $100 million worth of shares. This doesn't really work well from a math standpoint. So there's just a lot of factors weighing on the company and shares.
From a math standpoint, that's a great way to end that. Abigail, thank you very much. We appreciate it. We're counting you down to the closing bells. 15 minutes away. We're looking at the best streak of S&P runs since January. We're going to break it down with David Bahnsen, Chief Investment Officer at the Bahnsen Group. This is Bloomberg.
Look, one of the themes that we're talking about in our mid-year investment directions is the idea of having quality at the core of your portfolio. So quality which can be defined by companies that have strong profitability, that have low leverage, that have stable earnings. And we've certainly seen that come to fruition through the course of this year and last. And that, we believe, will continue to be with us for the next few months.
Gargi Chaudhuri there, BlackRock's Chief Investment and Portfolio Strategist for the Americas. She helped to kick us off to the close just about an hour ago, Alex, with about 10 minutes until we get to those bells here. And there's been a lot of discussion right now about what the next big trade is going to be. Is it going to be anything other than AI and big tech?
Yeah, I mean, look at those tech-heavy hedge funds we were just talking about. And the S&P continues to grind its way higher. And I mean grind, because it's not actually moving that much, but it's up for 6 straight days. We haven't seen that since January. But also, Apple is at a record. Amazon at one day hit a record.
Yeah, but why not, right? I mean, some people will say this is actually better than just a complete, 2%, 3% day run up, that sometimes you want these sort of incremental gains, because at least it shows you there is maybe potentially a floor to where we are.
Yeah, I was just looking at the volume here, and the volume isn't terrible either. That's also surprising considering we're mid-July. But you wonder with Scott Rubner of Goldman Sachs, right, saying the first 2 weeks of July are the best, and then it falls off after that.
Yeah, and then keep in mind, once you get into earnings too, investors are going to have a lot more they're going to have to consider than maybe what they've had to consider over the last 5 to 6 weeks.
Yeah.
All right, let's get some more market reaction here as to what's going on today and what could go on tomorrow with David Bahnsen, the Chief Investment Officer over at the Bahnsen Group. And David, we've been talking a lot today about big tech and AI. A couple of notes swirling around today, including over at Citi, basically saying that the tech trade and particularly the AI trade might be running out of steam. And at least for right now, it might be time to take profits. You buy that?
Well, I very much do. Of course, it's not a space that we own to begin with because it's outside of our mandate risk profile. I don't believe in this valuation to begin with. But if I were in the trade, I'd very much be wanting to peel it back. And I'm sort of impressed at Citi saying that because there's a lot more risk for these sell-side analysts in being early than there is in being late. I'm very accustomed to them coming out saying, hey, it's time to take money off the table after it's dropped 20%. So to do it before it drops 20 is a reasonably courageous call from Citi.
It's kind of courageous, but when you consider how far we've come, at least if you go back off those October lows of last year, and the idea that a lot of the criticism when that rally first started was that people were looking too far into the future for these valuations. And now you have people kind of trying to do it again, saying 2024 is over, we're already pricing in 2025. And it raises the questions about comps, for example, which are going to look incredibly crazy, particularly if we don't see this AI boom continue, but a lot of other metrics as well that I think are going to call into question whether those valuations were appropriate.
Oh, I very much agree. And I would also say the AI boom continuing implies that the AI boom gets past the backbone of AI, gets past the infrastructure. All the money being made in AI is in the kitchen. No money is being made in the dining room. This is very, very similar to the late 90s, where you did not really have websites necessarily delivering profits, but there were these huge run-ups in the Ciscos, the networking, the equipment, the hardware, a lot of the backbone of it. I don't think it's sustainable. I don't think the margins are going to hold. I don't think the revenue projections, but they keep having good quarters. And so it is what it is. I wouldn't time it, but they will end up having a disappointing quarter, and I can't even imagine what will happen then.
But David, this is kind of what Gargi was also talking about, that AI broadening trade, that it's not just going to be the chip guys, but she likes energy and she likes power, which is kind of your point. Like, it's the guts, the stuff, how you make it in the kitchen. What do you think about that?
Well, I think that's the only point of AI, is that eventually someone has to use it to drive efficiencies and productivity in their business. And nobody talks about AI as companies that are using it to do some part of their business better. And that part is the reason we don't want to talk about it is it's harder to measure. It isn't as clear that there will end up being the efficacy people believe in. And years later, even the internet, it changed everybody's life. It changed so much of corporate America, but there are 4 or 5 companies that were .coms in the 90s that ended up making a lot of money. There weren't hundreds and thousands. The main use is day-to-day people using it. I'm not sure AI holds the same promise in that regard, but it doesn't really matter. It's not instantly monetizable.
Right.
People are looking for big 20% monthly gains right now. It's fantasy land.
Yeah, and that's what Bank of America was saying about hyperscalers. They're spending the money, but you got to monetize it, and therein lies the risk. But what Gargi was really focusing on was power, like the power side of it. You need power for the data centers, for AI. Are utilities a good trade for you? Are they a growth area for you right now?
We own American Electric Power, which is up double digits on the year. Utilities were the worst performing sector last year. AEP has the dividend and the dividend growth we believe in. And yes, we think they can benefit from greater use. I don't think there's a ton of utility companies you want to go in there, because the ones that then are more levered to that space, they do take on a little riskier financial metrics.
So where does that leave us then, David? I mean, as we kind of look forward to whatever sort of rejiggering of portfolios folks are going to have to do one way or another, given some of the gains, this idea here that, you have to still be invested, or at least for a lot of investor managers out there, they have to remain invested here. Where does that leave them?
Well, I heartily recommend this thing called dividend growth, which of course is what we do in our business. But I'm not talking my book. I'm talking about an investment strategy that was very similar to what you led off the segment with, that focus. I believe it was someone from BlackRock talking about quality, talking about cash flow, talking about better debt metrics, more reasonable valuations. This migration to quality is coming. It's just a matter of when. When it does, I think good names in healthcare, good names in consumer staples, these are the types of names that are going to do well. One of the reasons we've done so well without owning any of the NVIDIAs this year is because of financials. You look at JP Morgan up over 20%, Apollo up nearly 30%. There's asset managers and banks doing quite well. There's a quality at some of the lower valuation worth looking at.
All right, David. Always great stuff out of you. David Bahnsen, Chief Investment Officer over at the Bahnsen Group, helping us count you down to those closing bells. And Alex, kind of fitting that he ended there on financials and bank stocks, because that is the leader here on the day, at least as a sector. I don't know if that's on the back of some of the upgrades that we saw, or maybe people trying to front run the earnings season that kicks off Friday for the banks.
Also, Jay Powell and the Senate Banking Committee seem to imply that those Basel III capital ratios may get rolled back a little bit, so it makes the liquidity better for some of these big banks.
Yeah, good point. I mean, you're seeing Wells Fargo, Citi, Bank of America all get pretty strong bids on the day. But guess what? Big tech still doing its thing. At least sans the software stocks. NVIDIA up 2.3%. Not that it needed another 2.3% gain.
Yeah, and the cyclicals are the ones that are getting hit. Aside from financials, you have materials and industrials. They're not holding up too well. Energy also, so that doesn't necessarily, there's no broadening out on that end.
Yeah, and then it's kind of interesting, too, you saw the moves in the Treasury space, which were kind of no moves. I mean, there was some volatility when we first got the Powell statement, but that kind of died down. So we're only up about a basis point, I think, on the 10-year yield right now.
Which raises the question, is it going to be tomorrow, Powell, or is it going to be Thursday CPI? And is any of that actually going to move the market in a material direction? It's
a good question here. We're going to try to answer some of those questions as we head closer to those closing bells. Our full market coverage right here on Bloomberg, it starts now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick here with Alex Steele, taking you through the Closing Bell. It's a global simulcast, starting right now with Scarlet Fu joining us in the TV studio. Tim Stenovic and Carol Masser are on assignment, filling in today. The incomparable David Gura and the wonderful Jess Menton. Welcome to our audiences across all of our Bloomberg platforms, television, radio, and our partnership with YouTube. On a day, guys, where we're seeing the S&P 500 set yet another record high, a whopping gain on the day of 0.1%.
Yeah, just astonishing. I mean, I think we're heading here for the 36th record day here on Wall Street. So the swell continues to rise here on Wall Street, and just struck here again by the S&P sort of inching up higher and higher, Jess.
That's right. And of course, when we're talking about the pace of these records so far this year, if you look at the first half, at that point, at the end of June, there had been 31. Obviously, we're on track for 36 right now, but that was the best pace of all-time highs for the S&P 500, the second best this century behind 2021, obviously behind what had happened during COVID. But if you're looking at this, obviously things being driven here, looking at our IMAC function as well, but seeing things still in the growth technology things moving higher today.
You know, Jay Powell basically stuck to the script when he spoke to the Senate Banking Committee today. But you know how we always talk about how whether the Fed has a third mandate, and that is the S&P 500. The stock market is at a record high once again. Does that complicate the matter at all when they have to decide on interest rate cuts? Does that become an issue?
Oh, man, not that again. A record high in the equity market. David Gura, have you missed talking markets? Is this a special moment for you?
It's a pleasure to be here.
Where you get to talk about record highs again?
It's great to see you.
We're happy to have you.
All right, 55.77 right now on the S&P 500 as we get the closing bells here in New York. I know Jess was counting. Alex always counts. Should these numbers hold, this would be the 36th record high. That's right, Alex?
36.
For the S&P 500 for point gain on the day, roughly about 0.1%. It takes a while for these numbers to settle, but unless something flips dramatically here, we are going to get that record high on the day. The NASDAQ also higher as well for another record high, 25 points higher, or about 0.1% as well. Meanwhile, the cyclical stocks not doing much of anything today. The Dow Jones Industrial Average down 0.1%. The Russell 2000 down about 0.5. And we should point out Dow Transports as a group down more than 1% on the day, Jess.
That's right, Romaine. So let's get a check on the daily. Advancers versus decliners, 46% rising, or about 229 stocks. If you look over at the decliners, though, 54%, or about 273, Scarlett.
Oh, that is interesting, because if you look at the IMAP, which breaks down the S&P 500 into 11 industry groups, 7 of those groups are in the green and only 4 are in the red. Financials leading the way, up by 2/3%, as Jay Powell made some comments that suggested the Federal Reserve will water down the capital rules proposals that have been put out there. Healthcare up about 0.4%. Utilities also marginally higher. Your decliners, materials, energy, and industrials.
That's right. So let's get a check here looking at some of the top gainers today. Of course, Tesla, TSLA, is the ticker symbol on this. If you look at that winning streak, they're actually moving to a 10th consecutive day here. If you look at this, gaining almost 4%. That actually was its best day in about a week since July 3rd here. So the back of this, you have Morgan Stanley sticking with its overweight rating on Tesla. So did note that the company shares of the global battery EV market in May was about 15%. You also, if you want to look at what's happening with some of its peers, though, if you look at Lucid, though, down a little bit over 2%, so worst day since June 28th. And then Nikola, if you look at that NKLA, though, that stock actually down about 7%. Its worst day since July 1st, though. So a little bit of a different story when you're looking at some of its peers. I want to move over, though, and look at U.S. listed ADR shares of Sony up about 4.4%. Best day since May 14th here. So, of course, that does come after Paramount Global's parent company, National Amusements, and Skydance Media did agree to that merger. And then lastly, looking at Corning, GLW is the ticker symbol on this, up about 3.8%. Its best day since July 8th. So that does come after the company did report preliminary core sales for the second quarter of about $3.6 billion, ahead of estimates of about $3.4 billion. David?
I thought about my decliners today as I ate a sad desk salad. I hit up Sweetgreen today. That's a company that we saw quite a bit today. And I think, as I look at this in complement with another stock that I picked, that being Kava, maybe a trend here is that given the macroeconomic environment, people are less willing I'm not yet in this camp to go and spend $16 on a salad at Sweetgreen. But we did see both of those stocks lower today. And the third one that I wanted to flag is Helen of Troy, of course, the beauty products company. There was this expectation going into today that the outlook wasn't going to be great. Suffice to say, is much less great than people thought it was going to be. So we saw a sharp decline in that stock price as well, guys.
Yeah, that's an understatement. Sharp decline there. I should point out, guys, I can get my salad for $10. I have said this, but you probably paid, what, $20 for your Sweetgreen?
Too much.
If that.
I'm ashamed to say. I won't admit it.
Yeah, no, mine's $10. I'm just saying.
Wait, what do you get? What do you?
Yeah, I got an egg and I got kidney beans.
Huh.
That's protein. All right, let's get to yields, guys, because that did sort of move, and I say sort of move because you saw some intraday moves within the bond market, but overall it was kind of a snoozer. The back end, a little bit of a sell-off, yields higher. You had a 3-year auction that had some nice solid takedown. We also get 10-year tomorrow and 30-year tomorrow as well, but it seems like we're doing okay with these auctions. The question then becomes, in terms of a steepener, do we finally get that steepener we've been waiting for? And is it the back end, those yields coming up, or is it the front end and those yields coming down if we price in a more aggressive Fed? That really feels to be the question in fixed income, guys.
Hey, something that Scarlett actually had pointed out that was in the Wall Street Journal earlier today. If you look at this, exclusive Ivy League social clubs are desperate for members. Not sure about, I didn't go to an Ivy League school. I went to a state school in Texas. But if you look at this Princeton club in New York City, losing members and bleeding cash before closing its doors in October 2021. So remaining members are exploring sort of this last-ditch overhaul to this 6-decade-old property that served as the Ivy League school alumni, but kind of want to get your thoughts on this dynamic in this story.
Well, look, I have not seen my friend Scarlett Fu at the Cornell Club outside of Grand Central Station, but I welcome her there anytime. I had a membership, I'll admit that, right when I graduated. It was extremely cheap. I have not renewed that.
Oh, so you had the starter rate, right?
I had the starter rate. I blanched when they said that it would be more after that, but maybe we can join together, Scarlett.
They need to upgrade their programming. I think that's the problem. You have a lot of old timers there who go there and they can stay there overnight if they need a hotel, and then they hold events sometimes. I know, David, you've moderated discussions over at the Cornell Club, but beyond that, they're finding it really difficult to attract younger people, Gen Z, for instance, to go to Cornell Club.
Younger people like ourselves, we should say.
Well, are we Gen Z?
No, I think you're like the prime target for these clubs here.
Definitely not.
And they are a little stuffy. I mean, I've never been invited to the Cornell Club, but I've been in the Princeton Club,
David
in the
Dora
Harvard
with his
Club.
starter.
I know. I got to get, or you, Scarlett. I mean, come on, step your game up here.
Does Northwestern have a club?
No.
We don't, right? We went to the same school, but clearly there's no club.
I think we have like a park bench or something like meet at here. Another story that actually I wasn't keeping my eye on. I don't know if it was you, Alex, or our senior producer who brought this up. Apparently, this is about rich people freezing themselves with the idea of being reanimated at some point in the future. Not necessarily a new concept, but it's kind of taken on a whole new level as of late here, as people have really started to try to game the system in a way that I guess assures not just their reanimation, but also their wealth.
Well, that's the thing. It's not just that they're going to be frozen. It's that they're now looking at revival trusts. So this is like an emerging area of law that was built on lots of different things. And basically, you can freeze yourself, put some money aside, so when you wake up, however many years later, you'll have money. So many questions, guys, like, will money be a thing? Can you still use it? Where does it sit? Can you access it? Is there a bank? Do you use your phone? Are there still phones? I don't know how this plays out.
I feel you describing this, and I feel much less bad about the sad desk salad that I had that cost $20 if people are spending money on this, but maybe they are. I don't know.
And you spent money on the here and now, right? You're not spending money to create a trust that may or may not exist because we don't know what things will look like in 100 years.
I have a dumb question, and forgive me, but when they freeze these people, are they dead first, or do they have to do it when they're alive?
No, that's actually a question. Are you dead if your body is actually preserved? I actually don't know if we have that answer.
Exactly.
That is a legitimate
this is important,
question.
David Gura.
I think we need a
these are the
philosophy
details
here.
that we need to know.
I don't think you're dead.
It's a fascinating conversation. I feel like this is what happens when we're waiting on earnings season to start pretty soon. But
what? No, this is hard-hitting journalism. What are you talking about?
Can't come soon enough, Jess.
Anyway, I think this is definitely a question. Also, will money live infinitely? That's like a really big thinker too, guys. Can it?
I was excited to talk markets, and now we're talking like deep philosophy.
Right? I know, this is a lot.
Yeah.
I think we should leave it here. This is a good place to leave it, right?
It's a social construct.
Right, that's just for our cross-platform coverage.
David.
We're going to have more coming up on the Market Close on Bloomberg Television,
what is that?
radio, and YouTube. All these questions that cannot be answered.
Or do you put the money in Bitcoin while you're frozen? Is this the way?
Will Bitcoin still be existent?
Yeah, to speed this up, Scarlett. You're Carol Massar now. prolonged goodbyes.
A reminder that Bloomberg Business Week is now on Bloomberg Originals. We'll be back tomorrow at the same time and same place.
All right, stick with us. Our coverage on Bloomberg Television continues with the preview of China inflation data expected overnight. Jason Su, chairman and founder over at Rayliant Global Advisors, going to be joining us on the big program right after the break. This is Bloomberg.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bostic. 6 straight days of gains for the S&P. That's the longest streak of gains that we've seen going back to January. And if you like a 0.1% gains on the day, Scarlett, you got it once again today. And she is right. Another record high for the S&P 500. Another record high for the NASDAQ. It doesn't look like much, but a lot of people will take it. That continued grind higher continues for yet another day. Look at what happened in yields today. It doesn't look like much, but there was a lot of volatility underneath the surface. We heard from Jay Powell a little bit earlier, and some of the comments did move the market, but eventually the market sort of recoiled and bought back. Bitcoin getting a little bit of a bid here on the day, and one of the biggest decliners here on the day, Scarlett, was actually in the software space. As a group, the application software makers down 1.5%.
We also saw banks do really well today, but I want to start in the energy space with BP. Of course, not traded in the U.S. This is the ADR that fell about 4.8%, but this is in line with the London-listed shares. Basically, the energy giant warned of significantly lower refining margins and predicted a $1 to $2 billion write-down on the value of a plant in Germany. What's significant here is that this follows a similar refining margin warning from ExxonMobil just yesterday. So question mark over whether Chevron might say something similar as well. Let's get to the banks. This is the ETF that tracks the banking sector. Banks in the S&P 500 and S&P indexes overall up about 1 2/3% on the day after Fed Chair Jay Powell said regulators will soon release a revamped version of their bank capital proposal. Of course, this is seen as a victory for the big banks, which lobbied very aggressively against the original plan. They argued that the rules forcing them to hold more capital on their balance sheet would hurt small business, would also hamper lending in the economy overall. And of course, it is Jay Powell's comments that did move the market today, and it's really our top story, his comments on the Fed's dual mandate. The central banker told the Senate Banking Committee that inflation is not the only risk facing policymakers. He said increasing signs of a cooling in job growth are now apparent, leading officials to be more mindful of the impact that higher for longer borrowing costs are having on the labor market. Now, Powell was careful not to offer a timeline for interest rate cuts, especially as investors look ahead to inflation data at the end of this week. Romaine?
All right, well, let's talk about inflation data, not here in the world's largest economy, but in the second largest. Inflation data due out of China at roughly about 9:30 Eastern time, with year-over-year CPI expected to rise to 0.4 from 0.3%. Joining us right now to discuss the investing outlook in China, as well as the broader emerging markets, is Jason Su, chairman and founder of Rayliant Global Advisors. Jason, great to have you here on set.
Hi, Romaine, glad to be here.
Let's talk about the China story, because for a while, everybody was looking for that rebound in the Chinese economy. It kind of went through fits and starts, and it seems like over the last few months, people have just kind of forgotten about them. At least foreign investors have just kind of forgotten about them. When you take a look at the economic picture over there, do you still see an investable opportunity long term?
Well, first of all, I think everyone was expecting the bazooka to come out, right?
Yeah.
They're hoping that Beijing was finally going to flood the market with liquidity, with credit. That didn't happen. Beijing is taking a very measured approach, a very focused and targeted approach, subsidizing or injecting liquidity and capital into select industries. So it's not sort of broad-based QE the way we would like it, the way we, of course, experienced it after every crisis in the U.S. So I think the market's disappointed by that. But I would say the long-term effect remains to be seen, right? So I think some of these targeted policies do make sense, containing real estate so that productive capital is squeezed out of unproductive capital, which is sort of real estate holdings, perhaps into the stock market, into risk assets, moving funds out of the sort of shadow banking into regulated financial assets. I think that's long-term healthy. So I think they're doing the right things.
Well, it's interesting you say that, too, because a lot of people look at these economic measures and they say it's not really the stimulus that they were looking for, but it is sort of a way to sort of stabilize the economy and, more importantly, to deal with, I guess, some of the excesses or mistakes maybe that came from past economic policy. So I would think that for investors, at least if you're a long-term investor, you would see this as a good thing.
Yeah, and there's something we need to understand about monetary policy versus fiscal policy, right? In the U.S., we like monetary policy, but it is the bazooka, right? You just flood the whole market, and hopefully the market figures it out and doesn't build another bubble. In China, they lean more on fiscal policy, which is, let's look at the strategic area that China would like to have an advantage in. Semiconductors, let's say, EV. Right, renewable energy, and they're focusing their fiscal spending there instead of flooding the entire market and hope that capital will go there. So it's just a different approach that we're not used to.
So this cautious stimulus has resulted in short-term and medium-term pain or struggle for long-term gain. What is the duration of this medium term? Because China operates on a different timeline than, say, the U.S.
So, I think it's anyone's guess. My guess is not going to be fast. I don't think it's this year, right? Because a lot of these policies don't translate into economic growth, economic gain until probably quarters, if sometimes not a year or two out. So I would say people shouldn't hold their breath and hope for something to immediately happen in the PPIs, in the GDP growth, and then immediately lead to a stock market rally. I just don't think that's the transmission mechanism there.
Okay, got it. And this is why so many people, at least in the U.S., kind of look at China now as less investable than it used to be in the past. Having said that, we are coming up on an election year. We're in an election year. We're coming up on an election in which China is kind of the common ground for both President Biden and candidate Trump. How do you see this playing out, no matter who wins, in terms of sanctions on China, tariffs on China, and the relationship that U.S. companies will have with China?
Yeah, so I would say, it doesn't matter who wins, right? It's either Joe, who's tough on China, and Trump, who says, I'm going to be twice as tough on China, right? So I don't think there's an out for China here. Now, what is interesting is, and I just came back from Asia, spending about 8 weeks covering the different cities. And what I generally hear from people, at least in the policymaking realm in Beijing, is, in some ways, Trump is a little easier to deal with, even though he might hit harder. At least he says, I got a very big club, I'm going to hit you over the head. What can you give me in return so we can negotiate? I think with President Biden, it was a little bit more difficult. So it's like a values-based conversation. It's like, let's talk democracy, let's talk freedom of speech, let's talk human rights. And I think Beijing is a little bit more confused about, well, how do I come back to that? What do you want, right? So I think for China, Trump might hit harder, but Beijing might actually understand how to deal with that
It's
better.
transactional in a clear way.
Yes.
Let's talk about some of the other countries in that region, or really in EM overall, because it's interesting how China, particularly coming out of the Trump administration, did try to make a lot of pivots in its relationships with other countries in anticipation that whatever its relationship with the U.S. wasn't going to get better here. Has that created more opportunities in some of those nations, or is that divorced from the China story?
Oh, absolutely.
Yeah.
Right. So I would just sort of go back in history a little bit, talk about ASEAN, right? The ASEAN trade arrangement was actually started by the U.S. as a way for the U.S. to build allies in the Pacific theater. But then China say, hey, we want in on that. And now China is actually the biggest trading partner to the ASEAN countries by by 2x versus the U.S. And this is what China's been trying to do, right? It's trying to figure out a way to not be contained. And the best way to do that is trade a lot with other countries. And what you're seeing today is the trade route has been sort of blocked a little bit. And so what China's actually doing is a lot of Chinese entrepreneurs are actually moving factories to Mexico, to Thailand, to Vietnam, to Japan, as a way of moving made in China to, say, made in Japan by Chinese factories, right? Made in Mexico by Chinese factories. So they're quite creative in terms of finding outs to solve this problem.
And does that actually get around, you think that actually gets them around some of the tariffs and other sort of, exclusionary policies that the U.S. would
Yeah, I think you'll have to, right? Because these are U.S. friendliest allies, right?
Yeah.
Japan and Mexico, right? For China to go there with capital, creating jobs, and sometimes helping with infrastructure, like you're seeing in Mexico, and for U.S. to say no, you can't do that. I think that may be reaching a little too far. So I think the U.S. also recognizing, look, how do you contain inflation? Cheap Chinese imports, even if it's from Japan and Mexico, helps with our inflation. So I don't think the U.S. is going to block all the avenues, because at the end of the day, there is a thesis that's good for both sides in terms of trading.
All right, good stuff. Really appreciate your joining us today. Jason Su is chairman and founder at Rayliant Global Advisors, based in Boston, but visiting us here in New York today. We talked a little bit about the stimulus efforts that China has moved forward with, even if it's not as big as many people had expected. Investors in China have given themselves a new nickname in a show of frustration with Beijing's failure to prop up the stock market. Instead of calling themselves investors, Romaine, some are calling themselves financial consumers.
This is why I love the Chinese, because this is like the ultimate shade, right? Like obviously they can't criticize the government the way we can here. But I just love this because the whole idea of it is that, hey, we're just basically putting money into the financial markets and we're not getting it back. So yeah, we're just kind of consuming what? The experience?
Yeah, we're getting an experience for sure. How you grade that experience is a whole different thing, but we're consuming.
I love it. And I mean, at some point, obviously, the government will have to address this if it continues at the pace, because eventually people will get upset as you would anywhere, as you would. But it gets to some of the creative ways that people are, I guess, trying to keep their spirits up.
I mean, do you think financial consumers will end up being something that's banned on Chinese media? Chinese social media?
I'm sure somebody's already stolen that already, right? Yeah.
All right, coming up, we've got the top three, where we focus in on the top three movers and shakers at the center of the day's big stories. This is The Close on Bloomberg.
Jumpstart your trading day with 2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
Bloomberg Open Interest, weekdays at 9 a.m. Eastern, only on Bloomberg Television.
It's time now for the top three, where we name drop the people driving some of the day's most talked about stories. And first up is Alec Baldwin. Jury selection began this morning for his trial over whether the actor committed involuntary manslaughter in the fatal shooting of a cinematographer on a film set 3 years ago. If he's convicted, he would get, or could get, I should say, up to 18 months in prison.
I've lost track of this case because I thought at one point they had sort of moved on from this, but I guess they revived it, and now he has to go to trial on this?
He has to go to trial on this. The opening statements should start Wednesday. And of course, this is something that has really affected his livelihood, his ability to make money, which is why he and his wife are now starting a reality show with their 7 children, or 8 children. I can't remember how many.
Who's counting? Okay, I did not know that. Yeah. All right, I'm keeping an eye on somebody. Not a lot of people know him, but he's really consequential to Nike. Tom Petty. He used to be an executive at Nike for about 30 years. He retired, I think it was back in 2020, but has now been rehired by Nike. But specifically, his task here, Scarlett, is for them to focus on rebuilding those partnerships that they used to have with retailers. Remember, they made this huge pivot to selling through their own website, their own channels, and now they're realizing they need the Foot Lockers and the Dick's Sporting Goods in the world to help get them over that hump here. We actually had a chance just last month to catch up with Sam Poser over at Williams Trading, an analyst there, who really talked about some of the talent moves within the retail giant and how it was hurting them.
They let go of a lot of senior people over the last few years, and those were people that really understood how the company worked. And you're dealing with the largest, one of the largest sportswear company in the world. And when you get rid of all that institutional knowledge, it isn't a good thing.
Institutional knowledge.
Yeah, no, absolutely. And some analysts say that Nike kind of shot itself in the foot when it hired a tech executive, John Donahoe, formerly of eBay, to run a consumer product company and introduce all these big strategy shifts, right? They laid off a bunch of people, hundreds of people, but he also reorganized Nike into women's, men's, and kids categories instead of by the sport. Right, so like baseball, for instance, or basketball, right?
But the one thing about Donahue too was he got lauded a lot early on, primarily for some of those strategies, not so much the women, men, kids thing, but certainly for the more DTC focus and that. And a lot of people were saying that was going to be the differentiator, and it helped Nike shares for a while until
it didn't, right? And then Hoka and On started to get a lot of the display space in Foot Locker and Dick's Sporting Goods, and are now gaining market share. All right, third on the docket for us is Tyler Dixon. He's the former global head of investment banking at Citi. Well, he's landed at Blackstone, where he will lead client relations for the firm's credit and insurance unit. It's a high-profile role because his team maintains relationships with the insurance companies, the pensions, the sovereign wealth funds, and the asset managers that invest their money with Blackstone clients.
So this is kind of interesting too, because this gets to the idea here of what's going on at Citigroup, where he felt the need to leave, but also the idea that how many times have we seen what used to be alternative asset managers, obviously Blackstone is much more than that now, luring sort of traditional bankers away from the traditional banks here, and you're still seeing that continue.
Absolutely. It speaks to the growing importance of private credit at formerly private equity firms, which are now just alt asset firms, right? Because they invest in everything. All right, we have some more breaking news, and it has to do with another person in the news, Jeff Bezos. Amazon founder Jeff Bezos selling $863.5 million of his shares. We know that Amazon shares had been at record highs recently, so people always keep a very close eye on the timing of these insider sales.
I'm sorry, what was the number again?
$863.5 million.
So that's going to, so that will take his, I guess, net worth, once he disposes of that money, down to about $220 billion.
Oh, okay.
So just by my calculation, if you have a Bloomberg terminal, you can watch all this. Type in Rich Go, and you can see what all these guys make, what they're all worth. $221 billion as of today, minus whatever he's going to do with that 800.
I know that raises a question. What is he going to do with the $863.5 million?
He should buy another house.
Well, he's got a couple in Florida. It's true.
All right, when we return, Scarlet Fu, we're going to take a look back down memory lane and the release of Donkey Kong and the advent of the modern video game industry. A question before we go to break. What existing fictional character was Donkey Kong modeled after?
I feel like it has to be King Kong, no?
All right, it was on this day, July 9th, 1981, where Japanese toy company Nintendo introduced what would become two of the most famous characters in video game history, Donkey Kong and Mario. A strange pairing of man and ape that came about after a flop of a game called Radar Scope left Nintendo with thousands of unused arcade cabinets and serious financial troubles. Nintendo's president then turned to his 29-year-old designer, Shigeru Miyamoto, to come up with something else, something that would resonate with U.S. audiences. Now, the result, it was a love triangle between a gorilla, a carpenter, and a woman. Crazy, I know. But what was really unique about this was that Donkey Kong would become the first so-called platform game, where characters jump over obstacles in multiple stages that together had a linear story arc tying everything all together. That's commonplace now, but it was revolutionary at the time. Now, the game was a massive hit in the U.S., with Nintendo selling at least 60,000 cabinets within 12 months, making Donkey Kong the highest-grossing arcade game of 1981. Donkey Kong Jr. followed in 1982, Donkey Kong 3 in 1983, and shortly after that, Nintendo, it gave Mario a brother, Luigi. And that brings us to our question of the day. Miyamoto had originally modeled the game of the cartoon love triangle between Popeye, Bluto, and Olive Oil. But Nintendo was unable to secure the rights to the Popeye characters, which led Miyamoto to come up with the idea of using a great ape as a stand-in for Bluto. Now, the mid-'80s boom in home video game consoles further aided the brand, and the success of Donkey Kong helped Nintendo become one of the most dominant video game companies of all time. Iconic consoles like the NES, the Game Boy, and the Wii. But times have changed a lot since then, and the gaming market is way more crowded. Just 2 months ago, in May, Nintendo said it had bought Shiver Entertainment to bring more games from outside developers to its next-gen Switch platform after decades of relying on its own software. The company, it's also embraced Hollywood. The first Super Mario movie followed a decade of internal discussions and hand-wringing, reticence over whether they should do it. But those fears, they were quickly allied. Super Mario Bros., released back in April 2023, went on to gross more than $1.3 billion worldwide, making it the second best performing film last year, right after Barbie.
There's so many ways I could comment on this, and it's just fascinating. By the way, I was Mario one year for Halloween, which involved wearing overalls, a hat, and putting a little mustache on my face, and wearing a label that said, "Hello, my name is Mario." But now I'm giving away my age.
Did you need the label? Did you do that? Or people,
yeah, I did.
Were people confused?
Yeah, but I played a lot of Donkey Kong when I was younger, too. All right, let's move on now to our big take. Once upon a time, there was shrinkflation, where companies shrink the size of their product while keeping the price the same. Now, consumers are confronting a new trend called upflation. Our consumer reporter, Leslie Patton, joins us now to explain. So, Leslie, what is upflation?
So it's a new tactic companies are using. They take items, sometimes ones that we're buying less of, like deodorant, shampoo, razor blades. They try to find a new use or a new occasion for this item, and they charge a premium price for it.
So okay, I mean, that's not wrong, is it? I mean, what exactly is the issue here? Is the idea that this is being done deceptively in some way, or what?
No, definitely not. The issue here is that during the pandemic, sales were great, right? These companies were able to raise prices and keep selling more. But now the price increases have tapered off and people are really pulling back. So companies are looking for ways to increase sales. This is one of the ones they've come up with, is coming up with new items, new occasions, again, and charging more for it.
So they're basically telling you all the different ways that you can use the same old products and saying, here's why you need to buy it yet again. You might have a drawer full of these, but like get the latest one because you can also do this, that, and the other, right?
That's exactly right. So think about the deodorant category. Maybe you already have deodorant that you use in your armpits, but now P&G has said we have Secret, Old Spice, Native even. We have creams and sprays and these different deodorants that can go all over your body. So not just in your armpits, but anywhere you want, on your feet, things like that. Food companies are doing a little bit of the same. So ice cream, not just for dessert anymore. Haagen-Dazs says you can have ice cream for a snack, and they've come up with these new bite formats that you can eat in between meals.
And we saw this also at like Taco Bell and a couple other the fast food joints. I think even McDonald's did something similar, Starbucks as well here. On the food side, though, it seems like that would be an easier sell than maybe a consumer product. Because I at least feel like if you're in a Starbucks or some other restaurant, you're more likely to make a kind of an impulse decision about, what you want. Because let's face it, you're hungry and hey, why not? If it's $1 more, sure.
Yeah, but remember, Starbucks tried selling wine and alcohol at some point later in the afternoons. They called it Starbucks Evenings, and they ended up doing away with that several years ago. So that didn't go well. It's not an automatic win for these companies.
Yeah, I think about, wasn't it Kellogg or General Mills that talked about how people are increasingly eating cereal for dinner and that's a new way to eat cereal, and it's a way to, for them, it was a way to like remind you, hey, cereal's there, like you can treat this as a real meal.
I remember them saying that. I don't think it's actually true. I mean, there are always some weirdos out there who eat cereal for dinner.
I've done this.
Okay.
When no one's home, I've done it.
Okay. When no one's watching.
Yeah. I mean, when I don't have to cook for anyone else, I'm like, yeah, I'll eat cereal for dinner. That works.
Okay. Yeah. All right.
Leslie, do you eat cereal for dinner?
Not usually, but my kids would love it if we did that. And companies, these cereal companies have pushed cereal for dinner. I think they even had a tagline at one point, like give chicken the night off, have something else. So they definitely are excited about cereal for dinner. Cereal is a late night snack too. Late night snacking is a huge category where these food companies are trying to get into and get people to buy their products more for too.
All right. Well, my son will love you for that because he will get up at like 11 at night here just to get some dry cereal with no milk for some strange reason. Leslie Patton, great to see you, by the way. Prior to Chicago there. Leslie Patton, consumer reporter for us here at Bloomberg. And we'll get more insight on inflation on the show. Bloomberg's chief future officer. You mentioned cereal. I had a chance to sit down with the CFO of General Mills, Kofi Bruce, and he talked a lot here about the ways they're trying to get you, obviously, to consume more, but also to consume better, too. And it's not, believe it or not, it's not about cereal. They've kind of moved on. They obviously have a big cereal portfolio, but they've moved on to a lot of other things. That premieres tomorrow at 9:30 p.m. New York time, right here on Bloomberg Television.
I wonder if he eats cereal for dinner. I bet he does.
I don't know. I mean, they had pasta. They took me to a test kitchen, and they're really big on like these healthy options. And you know what else they're big on now is pet food. That's like a huge part of their business.
Oh yeah, absolutely.
Yeah. So
more people have pets than they have children. So
yeah, and I think some people love their pets more than they love their children. That's a whole other topic of conversation. All right, but of course the question of inflation is going to be key for everyone out there, including consumers and the Fed alike. For the Fed, it's trying to decide that future path of interest rates. And we had a chance to hear from Fed Chair Jerome Powell earlier, testifying before the Senate Banking Committee on that topic.
Inflation has eased notably over the past couple of years. More good data would strengthen our confidence that inflation is moving sustainably toward 2%. The labor market appears to be fully back in balance. Labor market conditions have cooled considerably compared to where they were 2 years ago. We're well aware that we now face two-sided risks. If we loosen policy too late or too little, we could hurt economic activity. If we loosen policy too much or too soon, then we could undermine the progress on inflation. We continue to make decisions meeting by meeting. The likely direction does seem to be as we make more progress in inflation and as the labor market remains strong, we begin to loosen policy at the right moment.
The man himself, Jay Powell, speaking earlier here on the first day of 2 days of testimony over on Capitol Hill. Joining us right now is John Taylor, senior fellow at the Hoover Institution and an economics professor at Stanford University. He's also the inventor of the Taylor Rule, which is supposed to help guide central banks in where they should set the policy rate. And it was kind of interesting today, Professor. He was asked some pointed questions here about the rate cycle, whether we could see rate cuts. And he kind of made a case here that there was at least some glimmer of evidence there that maybe the Fed can start to do what they do. When you look at the evidence out there, whether it's your own Taylor Rule or whether it's the economic data writ large, do you see a case for it?
I think the case is coming soon. It's not there yet. I think they made the right decision today to keep the rate where it is, but it's going to come. We know inflation is going to come down, and we're all set for that event. There's no question about it. It's good. It'll be a good event.
Jay Powell talked about this idea, though, of maybe doing too little, too late when it comes to cutting rates. And there have been a lot of people in the market, Professor, that have talked about this idea here of the lagged effects of rate hikes and now making the case of the lagged effects of rate cuts and whether the Fed should try to get ahead of that or not. Is that something you would advocate?
I think that they're just about right at this point. A lot of people have been arguing they should have moved already. They held up and they have not done so much. I think can wait a little bit to 5.25 to 5.5 is about right. And Jay Powell mentioned the 2% goals several times, mentioned the unemployment rate 4.1%. So I think it's about right at this point. But don't go too fast, don't go too slow, do about right. And I think they're doing about right.
Yeah, I mean, looking at both parts of the mandate, right? You've got inflation, you've also got the labor market consideration. I also want to bring in what some people call the official or unofficial third mandate, which is the equity market. Stocks are at record highs. I believe the 36th record high this year remained for the S&P 500. Yeah, so even if the daily gains are actually moderating, we didn't see a very big advance today. How much is frothiness in asset prices like stocks a consideration for this Fed when deciding on the timing of a rate cut?
I think very little. It's really, things like the Taylor Rule looked at the unemployment rate, the inflation rate. We looked at many other things in the past, tried to get it simpler. It's not pretty simple. Let's look at the inflation rate. Is it above 2%? Yes, that means we have to be restricted a little bit more. And the unemployment rate is 4.1%, so it's about right. I think the question is, should you add other things? And the evidence so far from not just the United States, but other countries as well, is be careful about adding other things. I think it's hard enough with two right now, the inflation rate and the unemployment rate.
Okay, understood. Well, Romaine and I were talking yesterday about how the godfather of modern monetary theory was saying that the U.S. government fiscal policy bordered on irresponsible. He actually said the borrowing is like a drunken sailor. I wanted to get your read, Professor, on why you think 1.5 years of aggressive interest rate increases by the Federal Reserve has not triggered a recession.
I think the main reason is there's a lot of other things going on in the economy. A lot of people thought it would cause a recession, but it's not, and the future is really lower rates. I think you're right to mention fiscal policy, not just fiscal policy, but regulatory policy. They all go together, and I've always emphasized that. It's not just monetary, it's fiscal, it's regulatory as well, and it's also international. And so this is a global economy, and a lot of things are happening abroad, and so we need to keep track of what's going on in other countries as well.
Well, what is kind of that monetary policy mechanism, not just here in the U.S. with the Fed, but with some of the other big central banks around the world here? There's been a lot of talk about the effectiveness of monetary policy relative to maybe doing more fiscal policy measures to either stimulate or slow the economy. Do you still think that the mechanisms, at least the sort of basic interest rate mechanisms that monetary policy relies on, is still reliable?
I think it's very reliable, but you just cannot forget fiscal policy. You have a disastrous fiscal policy and a good monetary policy, things are a disaster. So I think it's important, but also don't forget the regulatory side. It's very important as we come into the next year or so, how we're going to treat that. I've emphasized monetary a lot. The so-called Taylor Rule has been around a long time. It's published by the Fed. They discuss it all the time. But I think it's not just the only thing. It's not the only thing to worry about. You have to worry about fiscal policy. You have to worry about regulatory policy and international policy as well. It's a global economy more than it has been in the past, and so we need to watch for that.
But part of the problem with that, John, and I'm sure you know this, is that obviously, at least here in the U.S., where you're supposed to have an independent Fed and really all the branches of government to have some degree of autonomy, it's kind of hard to coordinate that without running afoul of some of those rules here. So what is that solution? Is it just the White House and Congress need to keep an eye on the Fed, or the Fed should keep an eye on the White House? Like how do you thread that needle?
I think if the Fed has a procedure, which they got off a few years ago, they're now close to where they should be. It's not a rocket science, but it's pretty close. I think that would put people's mind at a bit of ease. The Fed is doing the right thing. And then it's time to look at fiscal policy and regulatory policy. Also, it's not just it's not just the Fed, it's other central banks as well. What's happening in Russia, what's happening in China, what's happening in Latin America. And that's an important part of the thing. Part of the equation.
You've mentioned regulatory policy a couple of times. We know that Chair Powell also mentioned that regulators would soon release a revamped version of their bank capital proposal. We know big banks have been lobbying against the existing proposal and want it watered down. If the Fed ends up doing that, is that a form of easing in a way to make it less burdensome on the banks?
It doesn't need to be. I think that it's the interest rate decision. And don't forget money growth as part of that whole equation. But the interest rate decision is very important. And what you do with the regulatory side, it's part of it, part of the equation, but that's the whole thing. I think at this point, with the interest rate 5.25, 5.5, we need to have have it come down. And don't forget how many times Jay Powell mentioned the 2% goal for inflation. And so that's the factor.
Yeah, he's held firm to that 2% target. John, really appreciate it. Really appreciate your joining us today. Thank you so much. John Taylor, he's a senior fellow at the Hoover Institution and economics professor over at Stanford University. We mentioned banks. Financials overall, the best performers in the S&P 500 today, up 2/3%.
Yeah, I mean, you had a couple interesting upgrades earlier this morning, and then, of course, the conversation about the bank rules, which I think everybody is just buckets and buckets of water on this thing for the last, 10 years.
Watered down, yes.
So who knows what it's going to look like at the end of the day. But it gets also to this idea, too, that if you do think the interest rate environment at least is stable, and you don't think we're going to get onerous new regulations and capital requirements here, and assuming that the banks actually show and prove when they start reporting earnings on Friday.
And we'll avoid recession.
Yeah, and avoid recession. It's a lot of components here, Scarlett.
It is. I know. Juggling a lot of balls there. Well, yeah. I mean, that's kind of the outlook that a lot of investors do have, and that's what's helping lift the S&P 500 day after day to new highs. You talked about a 6th day of gains here for the benchmark index.
But if we didn't have financials up, I do wonder if we had seen that. I know NVIDIA was up, and that was a big point contributor to the S&P overall. But if you strip out the Cities and the Wells Fargo's and Bank of America's of the world, we probably would have been in the red.
Absolutely. And you can see the Russell 2000 actually closed down 0.5%, and that's very finance heavy.
Yeah, a lot of regional banks in there. Why aren't they getting a pop, Scarlett Fu?
They're not the big banks, you know. They didn't have to put aside as much money under the original proposal. VIX elevated a little bit, but I mean, come on, 12.5, that's not really elevated. I mean, just ticked higher. And the 10-year yield not moving a whole lot, 4.29%.
Yeah, absolutely. And this gets to a question, too, as to what moves that yield. We have that CPI report on Thursday. Obviously, Powell testifies tomorrow, but it's going to be kind of a rehash of what he said today. But you do have that CPI report on Thursday.
And PPI, not to mention on Friday as well. Yeah. All right, this is The Close on Bloomberg. So the eyes of the world will be focused on the NATO summit taking place in Washington starting tonight as President Biden prepares to deliver remarks in just moments from now. Let's bring in from Washington, Bloomberg's Iain Marlow. So Iain, 38 world leaders are gathering for the 75th anniversary of NATO. This was meant to project confidence and alignment to folks like Putin of Russia. But it feels like what it's become is one big test for President Biden, a fitness test.
Yeah, exactly. I think every world leader coming here for the summit is going to be watching Biden really closely to see how he's holding up, and in particular, how he'll do in November, given Donald Trump is the one he's facing off against, and he's the one who said so many, testing things about NATO in the past, about not defending certain alliance members who don't pay up, letting Russia do whatever they want with members who don't meet the minimum funding threshold and the like. So I think it was meant to be a celebration, and I think it's a bit of a trying moment, a bit of a fraught moment for the alliance right now.
A bit of a fraught moment, of course, with the Ukraine war still going on now, heading into I guess what it's going to be its third year. Iain, I mean, how much do we know about NATO's response in providing potentially additional support to Ukraine, and more importantly, just really trying to shore up what really started when this war kicked off, which was this idea of making sure that the periphery of Europe is protected?
Yeah, that's the primary focus this week will be Ukraine, the security assistance, the package that NATO manages to provide. The stuff that we're hearing from U.S. officials is F-16 jets, more air defense to protect Ukrainian cities and civilians from Russian missile strikes. We obviously had that strike just the other day on the Children's Hospital in Ukraine, which everyone has sort of been talking about for the last day or so, and then of course the security guarantees for Ukraine, and talk about their eventual membership in NATO and whether they'll be, Zelensky has been trying to get invited into NATO for the past little bit, and so I think we're not expecting any sort of formal invitation, but there'll be some language suggesting they'll eventually get there, though it won't be exactly what Ukraine wants.
Yeah, absolutely. And we've already heard from the NATO Secretary General looking like he's already fallen short of trying to corral everyone together. It will be interesting to see what happens over the next 3 days. Iain Marlow down there taking a closer look here at the NATO 75th summit here, 75th anniversary summit, I should say, as that kicks off right now down in Washington. Still ahead, we're going to set you up for some of the big things that investors need to watch over the next 24 hours. This is Bloomberg. All right, let's take a look at what the market's going to have the eye on over the next 24 hours. We start overseas in China and some economic data.
Yeah, CPI, PPI, and these gains are fairly modest in terms of what's estimated. Certainly a far cry from what we're going to expect from the U.S.
Yes, that's certainly to be sure. And speaking of the U.S., we get some economic data back here. Not a huge economic data point, but something everyone's been keeping an eye on, and those are those weekly mortgage applications.
Yeah, because mortgage rates still remain elevated, and this is a big sticking point for consumers and home buyers, right? They can't get the homes because affordability is a big problem with home prices being elevated and mortgage rates being elevated.
And that feeds into all this debate about inflation. We always focus on food and some of the other things, but housing costs, whether you're buying or renting, is a big factor in that as well. Interesting event going to take place over in Paris tomorrow at 9 a.m. involving Samsung.
Yeah, they're releasing a health tracking feature that the Apple Watches currently don't have. So they're hoping to get a leg up on the competition.
Okay, this is like blood oxygen levels. Are you like a triathlete or something?
No, I mean, I don't even know how I'd use this. But I don't think they're catering to me, so.
I don't know, or nor me, but nevertheless, maybe it potentially moves the needle for Samsung. Meanwhile, back here, more Fed speak. Fed Chair Jay Powell on Capitol Hill for day 2 of testimony.
This time in front of the House Financial Services Committee. It's usually the second day. It'll be longer probably because there are more members who have to get through their line of questioning.
Yeah, I'm sure it'll be a very
they can often go off on tangents.
Questioning. And also, if you're not done with Fed speak, we're going to hear from Austin Goolsbee, as well as Fed Governors Michelle Bowman and Lisa Cook.
They'll be saying from the same hymn book.
Well, let's hope so. Anyway, thanks for joining us. I'm Romaine Bosick. That's Jack Tripper. We'll be back tomorrow right here on The Close on Bloomberg.